So we started today, finishing the week with a strong move to the downside. Continuing that 3-day decline that we've had in the middle this week, but a good, positive, bullish patterns to finish off the day, to finish off the week, similar to how we started the week. So I'm going to break down how those correspond to what we expect going into next week and why, and the different relationships that can impact where we go next week. And I'm also going to break down too a trade that takes advantage of a failed breakout in the US dollar. So let's go ahead and get started. Today is Friday, March the 2nd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that found us for the first time, that are watching for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click that red subscribe button right down below the video. You can do that right now while you're watching. Also, while you're down there, click the thumbs up icon. That lets me know that you got some value out of it. It also tells me that you want me to keep doing these videos. One click, very easy way to give us some feedback there. Also remember to comment on anything that stands out to you from today's video. I like to see what you're getting out of it, because then we know what to talk about, what you're getting, what value you're getting out of these videos. Also, join the daily Market Outlook email list. I send out an email every day, time-stamped hyperlink summaries of what we cover in these videos. So get those emails, click the link down in the description below to join the list. Follow me on Twitter for more content in addition to these videos. You see my address on the top of the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. That way Twitter keeps pushing you all of the stuff that I put out there. Finally, join the Market Outlook community on Facebook. Now we are over 900 people on there. Join us. Be one of those. The link to join is down in the description below as well. All right, so let's take a look at the S&P 500 here with the market forecast indicator. You'll notice that, I actually had to move these ovals down. Now, I've been getting some questions about what these ovals are. I've noticed on Twitter and in the YouTube comments. The green and the red ovals are highs and lows of the blue line. So again, a trend is higher highs, higher lows, or lower highs and lower lows. That's what an up or downward trend is. The question is, what are highs and what are lows? If you ask 100 different people to pinpoint the highs and lows on the trend, you probably get 100 different, answers. It's because, everybody can see different things. And so you want to be consistent when you're trying to define the trend on one chart versus any other chart. Like if you were to pull up SPX or SPY or IWM, whatever it is, you want to have some consistent method. And using indicators to do that, especially oscillators, is a great way to, especially multiple indicators you'll see here in a second. If you can, if you can use that combination or whatever it is to help you be consistent, then that helps make your trend analysis more consistent. And so that's what I'm doing here, is I'm using the blue line. So anytime it peaks above 50, whatever the midpoint of the chart, if it's 50, if it's 0, whatever it is, anytime it peaks above the midpoint of the chart, you get a red oval. Anytime it bottoms out below the midpoint of the chart, you get a green arrow. And the blue oval, the blue oval is the one that we're currently on. So we actually need to duplicate this one and put one up here, because that's our last near-term high. So you see how we've gone through to a lower near-term low after getting a higher low and up to a higher high point. In fact, I need to duplicate that one too. So we had a bullish trend going until the steel tariffs came out. And then we broke through yesterday's low point on the steel tariff announcement. But you notice today we got a little bit of a what would that be, a piercing line, where you close lower or open lower after down day, open lower, and then finish up to about the midpoint by the end of the day. So good move, good close to the week. As you'll see, it produced, that produced that long lower shadow for the weekly chart. So it's a positive sign. Not as long as it's been in the past, but regardless, still a good sign. Not as long as that one that we had that a couple Fridays ago. The near-term momentum line both came out of the reversal zones, but we do have a bearish posture. It's a relatively weak bearish posture because the near-term line is still above 50. And remember, getting below 50 is significant. So technically, getting above 50, you can get some weak bearish postures while you're still up there, and this turn right back above. So we'll see, where's that next near-term peak going to be. You would expect it, if we continue the trend, to be at between 50 and 80, and for this the next oval, red oval, which the highs would be somewhere in this area. So That's what we'd expect to see until we don't. So you notice we're going to have some resistance here at that low point, which was our support, a near-term support. So we'll have some resistance there coming back up, and we'll see if we can break through that and get back going again and reverse that intermediate line that's already above 50 and keep it up there. All right. You can see market sentiment still pointed lower, still higher, but still pointed lower, and making a lower move, which is actually a good sign for the possibility of a new of this run to make it a lot longer. You notice here's the line. That's your 23% pace for the calendar year that we were on, and we were actually above earlier this week before falling those 3 days in a row, and then the subsequent bounce up today. So bearish posture, but a relatively weak bearish posture. Near-term sentiment's improving. We'll see how much it improves to determine whether or not we're going to keep this intermediate line rising, or are we going to continue to drop. And you'll probably either get the spike in the momentum line up to an extreme level like we did right there, when we came off that low point, or we'll get the near-term line into the upper reversal zone again like we did right there. Here we got both of them. You don't have to always get both of them when you're changing the trend. But we get a nice good bounce up, then that will keep the intermediate line going. And if you notice the Dow Jones Industrial Average looks very similar, practically the same chart. Here we go. Not the same kind of piercing line pattern. Didn't rally as much. You notice it was actually down on the day. The intermediate lines pulling back. The short-term sentiment still trying to come out of this reversal zone. And falling market sentiment, which remember, falling market sentiment makes the path of least resistance to the downside. And remember how we also talked about that we can fill in the range of those long lower shadows. That there's going to be some support at the bottom of that, but we can, and just because we kept going up every day practically here, didn't mean that we wouldn't fill in this area. And that's we talked about that when we were coming up off of this. We looked for more of a near-term pullback here that we never got, and so because we never got it, we now we're getting it. Now we're pulling back into Fibonacci retracement areas for that bigger move. That's the Nasdaq, which is or Dow, which was a little weaker. The Nasdaq was much more positive. Look how bullish that was. So the technology sector continues to be a little bit of a leader, back up above that old low point of 7,200. So a positive sign for the broad market as a whole, because there's your market leadership. And then there's a morning star candlestick pattern on the Russell 2000, another bullish reversal pattern. You can see also getting a smidgen above those old low points, and short-term sentiment looking much better there, up 1.75%. So good day for stocks for these kind of smaller indexes. It's those large cap stocks which were impacted most by the news yesterday, but a good finish to the week that suggests that next week we can kind of get back and get going again. Whether or not we'll rally up as much next week as we fell this week remains to be seen. But good finish to the week that suggests that this kind of weak bearish move we have on all these indexes is most likely going to turn back up and stay up above. You can see the Nasdaq not anywhere close to dropping back below 50 again. All right, let's take a look at the long-term chart. And again, we got another arrow, and we've talked about that in the past. We're going to get more arrows now that the gap between the 50 and the 200-day is closing. We're not anywhere close to testing the 200-day moving average, but we are back below the 50-day moving average, which produced the arrow. Don't be surprised if we don't get another green arrow. And again, for precedent here, when we were going up so far so fast, once that MACD started to come down, you notice how we were up, down, back up, down, back up, down, back up. We were getting arrow after arrow after arrow, while still rising on these averages while the gap was narrowing. And so here's, yes, the 50-day moving average is falling here, but we still got an easily rising 200-day moving average. So that we're getting some volatility. That's what we'd expect. Looking at the 3 green arrows, you can see, again, we now have 3 red arrows here, and that all came today with the MACD and stochastics crossing. You can see the MACD smidgen below its moving average, stochastics crossing below its moving average too. You can see how far away we are below the 8-day moving average, bouncing back up. And if we're going to change this trend next week, so remember how the posture is bearish, so we expect that bearish near-term high. If we're going to change that, we first got to get above this 2,700, which is that old low point, like we already have, you remember, on the small cap indexes. And then we got to reclaim that 8 and 17-day moving average. So if I were to look at the Nasdaq for this, that's what we already have done. We got above 7,200. We got above all these moving averages. The 8's already above the 17, so the MACD is still positive. and they're both close to crossing above. So that's what we need to see on the S&P 500. Considering the Nasdaq's already done that, it's a positive sign. The Russell, while not as bullish, you can see got a little bit above that old low point. Not a solid breakout like we saw in the Nasdaq, but back above both the 8 and the 17-day moving averages. And you can see the MACD, pulling back to its moving average, is bouncing up. So, again, these small cap indexes are kind of showing what we would want the other indexes to do. What you'd want the other indexes to do, the large cap indexes, next week, if we're going to maintain this kind of bullish posture, that intermediate line. Yeah, it's weekly bearish now, but if it were to stay above 50 and turn back up, that's kind of what we need to see in this next week. And like I said, normally you wouldn't expect a change in trend. We expect that bearish near-term high, but the Nasdaq and the Russell tells us that we can probably expect the S&P and the Dow to continue to push up through. Maybe not the Dow, because they've been impacted the most by this negative news, but the S&P 500, if it follows suit, then that kind of starts to steer our expectations towards more of a bullish week next week in the near term. All right, so we take a look at the intraday chart, and you can see how we opened up below. We gapped down, opened up below yesterday's low. There's where the piercing line comes in, and then gapped up. You see where we finished, though, and why the midpoint in this particular case of this this longer down candle here. That's the definition of piercing lines, where we get back to that midpoint. And you see we did close down a little bit, and the after hours kind of pulled back up a little bit closer to it. But that's the midpoint. That also happened to be the low of last week, the midpoint there. And if you take a look at the 4-week range, you can see again how the 4-week range, we have to move this down even more now to the high of the second. And then after that, it's going to come down even more. So here's the second right there. So you got to move that down to this high, and it's going to keep coming down day after day until we get to that high point, and that's going to be that's going to be the next high here for a while. In fact, it's only just a little bit lower, but you can see here that's going to be the low point for about another week or so. So we're looking at a low of 253, sorry, and the high here at 279. So 279 to 253. Ends up being about 13 points. Then you add that to the low of 253. So we're looking at 266 as the midpoint, which happens to be yesterday's low point. And we, a little bit below that, and we're back up above. So just like that, we're back into the upper half of the 4-week range. So consider how bearish we've been and how bad that's been. And we were right back into the upper. Remember how we talked about things aren't too bad until you get into the lower half of that 4-week range. And we maintain the upper half, and again, especially as we move this, even before we move this down, but especially now as we move this down, that's going to be the upper half of the range here. So, and again, you can see why it stalled where it did. That was a support level. This 270 is a support level, and we hit it on the way back up. We break back up above that through Monday, and you've got some room to move up to 275 really easily, and then eventually back up here to 280, which would be the top end of the current 4-week range, or at least get the top end of this 4-week range. So again, as bearish as that's been, you can see how easily things can turn around, and again why we didn't get more of a pullback here than we probably should have, and then you push up really quickly, and this was a move from 270 all the way up to almost 280. So you had a pretty decent move right there, about an 8-point move just to get to that point. Or 9-point move. 279 looks like the high point. So you got a 9-point move in 2 days. Now you add that onto this, this 10% move we had off that low point. It's a big, big move without an exhale, and there's your exhale. Right? We just ended up getting a little bit bigger. We take a look at the range today in the volume. You can see the range at 5 points practically. Yesterday's range over 7, so extreme range. Volume is just a little bit above average, and today back down to a little bit below average. So you look at that here in context. 5-point range again above, but not extremely high, and then the volume here just a little bit below that average. So we want to start getting some smaller ranges and smaller volumes, but they're going to be big right now, especially with the VIX You can see the VIX pulling back down below 20 by the end of the day after getting up to above 25 at the open today, getting right back down to below 20. So you can kind of see, again, that's a very positive sign for the markets, and also on a relative basis, getting back down here below 1. So we were really extreme here at the open, above 110. All got up to 130. The VIX did on that spike, but then all the way back down to below 1. So things normalizing very, very quickly by the end of the week with today's intraday move from the opening gap significantly lower to the end of the day. Okay, now let's transition to what's driving this price action. Just a quick reminder, remember to like and retweet the Market Outlook tweet here that I pinned to the top of my Twitter timeline for those that follow me on Twitter. Again, it benefits you because Twitter knows you want to keep seeing my stuff. Benefits me because the more engagement there is, the more Twitter will push this out to everybody. So, and again, we kind of look at that to see, how much interest there is in videos like this. And when you like it, that tells us you want us to keep doing it, keep doing these videos here on YouTube. So, that being said, we'll take a look at what's driving this price action here. And you can see at the beginning of the week, a nice good bump up in crude oil prices. And then crude oil fell down. At one point, was down over 5% at the open this morning. And had a couple of days now where crude oil's rallied intraday, but down 5% for the week. That was a big, big drop. And even emerging markets had a bad day. Not quite the good day yesterday at crude oil, but down 5% as well for the week. Whereas U.S. stocks were only down 3.5% at one point in time for the week, and well off of its high point earlier in the week. In fact, from that high point down to that low point right there, stocks were down 4 3/4% in that 2.5 day period. So pretty big declines intra week, and you can see the gains getting us back. Getting us back to that 2% loss for the week in the S&P. Look at small caps really taking off today. Remember, that hasn't been the case. Small caps have been really lagging behind. Let's take a look at this long-term chart and pull up this ratio chart over here on the left. We'll look at small caps versus large caps. Remember, small caps have really, really been underperforming, and now they're, this last little push has pushed us up above the 50-day moving average of that relative strength line. So good, and kind of a break up above this last few weeks. So very first positive sign we've seen for small caps in months in terms of relative performance versus large caps. So nice, good move higher. You can see bonds stayed up today, but you can see today at the, with just today's move, bond prices were down, so yields were up, but that didn't keep stocks down. You can see stocks were able to bounce back up. That's been a bad thing for stocks here lately. And again, just going from the high to the low point, crude oil has been a big, big factor, and there's all your equities, and you can see bonds. Very, very safe haven. You can see, look at that gap between corporate bonds, high yield bonds, and stocks. High yield bonds just weren't dropping, and they kind of held their value while stocks, the stock market kind of caught back up to it. So another sign, we talked about that on Wednesday, a sign that sell-off pullback, very technical oriented to the stock market and just to the stock market. And as you see, when we rally off these low points, and just looking at now today, when we rally off that low points, to see small caps outpacing large caps by such a gap, to see emerging markets outpacing developed markets by such a gap, to see crude oil taking off up 1.4%, then you can see risk appetite was right back in mode and finished the week strong, with long-term bonds also continuing down. Again, that's been when long-term bonds have been kind of holding and pushing stocks down. Not the case today. Dollar kind of flat and everything taken off, even high yield, which didn't go down nearly as much as stocks, had a good finish to the week too. So risk appetite back in force. There wasn't a whole lot on the economic calendar. What's interesting, and again, everything is relative. Everything is relative, and especially in these international markets. Look at the economic surprise index. Yes, we are down to 39 from where we were above 80. But remember, 39 is a pretty high level relative to past years. But look at the international. you can see how international indicators are not nearly as strong. So there's been a lot of chatter about this tariffs and what's going on in the U.S. But you can see GDP estimates back up to 3.5% yesterday. The economic surprise and even here the rate hike odds jumped up here earlier this week, but kind of moderating today. In fact, going out to the fourth rate hike here, 1, 2, 3, 4 would be 225 to 250. You can see a little bit of a rise in odds for that. So now at about 29%, almost 30%. That's down from where it was earlier this week at about 33 to 35% odds for that fourth rate hike in December. So as those odds pulling back, that's what weighed on the market so much. Then you had the tariffs, but that's not really impacting. You can see the global economic environment. And you remember, again, everything being relative, things are looking worse right now globally than they are here domestically, and that's gonna attract, especially with higher yields now compared to like German yields and Japanese yields and everywhere else, developed economies. Those higher yields are going to attract capital, and the more money comes in, then things moderate and things settle down again. Ends up being a positive. And again, yeah, it might look bad on an absolute basis when you're just looking at the U.S. and tariffs and higher yields and all this and all that. But remember to put it in perspective and compare it to what's going on elsewhere. And right now, we're looking pretty good compared to looking elsewhere. We can do a similar analysis here, again from the start of the week until the end of the week. And you can see technology has been a strong move at the beginning of the week. Then we fell and you can see by the end of the week, technology and consumer staples that's not the most common combination there. Ended up being strong performers. But look from the high to the low, and what really dragged down, of course, the energy stocks. You can see financial stocks dragging down there as well. Industrial stocks, ones that are impacted there by the news. You can see they gapped down significantly today. They fell a lot yesterday during that drop off. So those industrials impacted the most. But look up here. You can see during that drop off at the beginning of the day today, look what didn't drop off was your utility stocks, your real estate stocks, your consumer staple stocks. So pretty big divergence here from the close yesterday to the open today. Sell off in these riskier asset or sectors compared to the safe haven areas. And then we say, okay, well, from that low point back to the end of the day, those safe havens didn't really move. They still rallied. Utilities didn't rally, but these other staples and real estate rallied, and there's materials there. But look at technology resuming its lead position, its pole position, pulling back along with the market during the sell-off during the week, but leading at the beginning of the week during the jump up, leading at the end of the week during the jump up. So it continues to be an outperforming sector here. You can see everything else kind of matching the market. Healthcare kind of matching the market. Consumer discretionary, which has been a top performer, kind of matching the market there. Of course, your utilities and your real estate are the ones that had the biggest losses over the last so many months. Here, let's go out to a 6-month chart here. They're the ones that suffered the biggest losses. They've got the biggest to rebound, and they're still kind of down there. There's still going to be some opportunity for some relative performance. But for now, you've got that technology and consumer discretionary are your kind of strong areas. And when you look at that dollar index here, nope, not that one, this one. When you look at the dollar index, it looked like it broke out here above this, 90, what would that be, 90 and a half, 90 and a third area. It looked like we were going to break out. We got up to the top end of that Bollinger Band, and then we pulled back down and got back below that 90 and the third level. So if we were to break back below this upper band, there's going to be a test here. If we get back below that, that's going to be, it's been positive for the stock market to have a weaker dollar. And if this ends up being a bear flag, which it looks like it's setting up to be, breaks below that moving average and eventually breaks below these lows and continues lower, the stock market that's been a positive for the stock market in the past. And of course, the sectors that do better in that area are the energy and material sector, and we've seen technology being a strong gainer during this period as well, and resuming that leadership just on a short-term basis multiple times this week. All right, one of the casualties, I guess you could say, of the strong dollar moves that we've had this month of February, some ups and downs, but pretty much mostly up for the month, is the energy sector. And again, ups and downs, but you can see mostly down from this peak in mid-January for National Oilwell Varco, which is one of the stocks in that energy sector there. So a little bit of a morning star candlestick pattern forming here with a green arrow on the moving average. But you can also see here that we had come down. We had gotten above that upper line on the downward sloping moving average, which can act as resistance when you're in a downward trend. We broke through that, came down, hit it for a new support level, and then formed the bearish candlestick. And of course, with the dollar potentially falling and the weakness that can have, that it can add to the benefit that can be for the energy sector. Again, we talked about when the markets are bullish and the dollar's falling, then the energy and material sectors tend to benefit from that weakness in the dollar. You can see there's opportunity here. So, and you take a look that we've got this low point. We've got a multi-day, over a couple of weeks, low point around 35. So you say, okay, well, what if I were to sell that $35 put and buy the 33? It's more credit than what I need right now. So what we're going to do is we're going to put an order with a $2 wide spread. We're looking for about 47 cents. You can see it's a pretty tight spread here. So let's go for about 48 cents credit, and we'll put a stop limit order. So what that means is that we're going to wait for it to for the credit to fall, so get less return. And I got a good question about this in Twitter as well. Yes, we are going to accept less return in order to get a higher probability. It's an inverse relationship between the amount of return you get and the probability of success on a trade. Right? No matter what strategy it is, whatever it is, anytime you get a higher return, so for example, you get a higher return trading in the stock market than you do in the bond market with the yields you get in the bond market. But there's a much higher probability of success of making money in the bond market than in the stock market. So there's an inverse relationship, right? You can make a lot more money buying calls than you can selling put verticals. But you have a higher probability of success selling put verticals than you do buying calls. So there's always that inverse relationship. And even within the put vertical itself, if I were to say, okay, I wait for it to fall down to 48 cents, you notice it says here that I need the stock to jump up a little bit more to make sure, that we are clearing and getting off of this low point, knowing that if we were to break down below this low point here, then we have a decent odds of success, or if we were to break below that low point, then right around $34 here, then I'll get about a $40 loss for a $48 gain. So, and there was a good thread, a good back and forth on Twitter today too about, do I take that loss? And remember again, there's two bad things that can happen when you get out right there. One is the stock can bounce right back up and get right back up above 35 and you miss out on that $48 gain, right? The other is that it can keep going down, get below 33, and you lose $152. So there's two. That's two. So what's worse? Losing $152 or missing out, losing $40 and missing out on that $48 gain? Well, one of them, if you add those two together, is about $96 total. Again, that's so there's a difference in your account of $96, almost like, when you're playing basketball and you miss a shot and you go down and you give up a shot. It's like a 5-point swing if you give up a three-pointer, for example. For those of you who don't know, the idea being is I missed out on that gain and I had that loss. You add that together, and the worst-case scenario is a $96 swing. Here, the worst-case scenario is $152. So what's worse? Well, that is because how many $48 gains does it take to make up a $152 loss just to get to break even? And remember, the odds of the $48 gains only 62%. It's not 100%. So it can take a while to make that up. And that's why it's always worse. It's okay if we end up taking that loss. And that's why I like to put this break-even point here, or this kind of crossover point, below a support level. And in this case, would be below that 35 level. So we have a basis for being in this trade. We have a technical support level here. As long as that holds, great. And if it doesn't, and we break down below that, then we'll just take a small loss. And taking a small loss It's something everybody needs to learn how to do in order to achieve success selling vertical spreads in a high probability way like we teach, like we've been teaching here in these videos. So to summarize, the market has been pulling back this week. Again, probably some of what should have been more of a pullback last week is showing up today, of course, or this week. But of course, a lot of that driven by news and driven by this tariff news. But remember, again, there's a lot more that affects the markets, especially on a relative basis from U.S. to international, and we see there's a good move to risk appetite to end the week on with a failed breakout on the U.S. dollar. So if that dollar keeps pulling back here next week, we've seen in the past a positive benefit that can have on stocks. If stocks get back above this 270 level, staying in the upper half of its 4-week range, then we might see a move back towards the top end of that range. So again, as always, thank you very much for watching tonight. I appreciate the time that you spend watching and the engagements. Remember to like, subscribe, and comment on the video down below. Also remember to follow on Twitter, like and retweet tonight's Market Outlook tweet, and of course join the Market Outlook community on Facebook with the address, the links down in the description below. Have a great weekend, everybody. We'll see you all on Monday.